Lots of changes going on in the mortgage industry these days. This is one of them that's being talked about a lot right now. There's definitely some revamping going on behind the scenes, the way that Fannie Mae and Freddie Mac are pricing out their loans, which is tied to interest rates. I don't know if I'd necessarily say that people with a higher credit score are footing the bill for people with lower credit scores and lower down payments, but let's dive into it a little bit and see what's going on. So the nuts and bolts of this is going to be tied to LLPAs, or loan level price adjustments. And what that is going to be is it's going to depend on a few different things. And it's going to determine the costs and fees associated with that interest rate. Now, pricing is what affects interest rates going up or down. So when the pricing changes, depending on those factors, that's when you're going to see a different interest rate offered for you. Now, what's changing is people that have different credit score tiers and different down payment tiers are going to be getting different LLPAs than they had in the past. This chart's a great way to visually kind of see the difference here of what's going on. So the cheat code may have been if you had a 780 credit score and you would put 15% down, which would require a little bit of mortgage insurance. That meant there was less risk to the lender themselves. So you might get a lower LLPA. So less costs associated with that. And really what's going on is there's a revamping, kind of a leveling of the playing field to put a little bit more risk back on the lender. None of this information should be anything that stops you from reaching out to your agent and your lender partner and have that conversation. It's still an amazing time to make a house your home.